in the meantime, just know that the BRICS and the rest of the world outside of this little United States bubble that we live in is buying silver and gold. And the price is only kept in this area so they can accumulate more. And when they're done accumulating, when there's no more above ground silver to be had, then the price will float higher.
Get ready, because the future is closer than you think. Today, we're joined by Lancy to explore a crucial aspect of the financial world. In a world where actions speak louder than words, Vince reveals the hidden truths of the silver and gold markets. Tune in as we unravel the mysteries behind global trends and discover why the rest of the world is stockpiling precious metals. It's a wake-up call to the reality beyond the United States bubble. Don't just listen. Learn how to trade wisely, especially from the short side. Because, as Lancy suggests, tomorrow is approaching, and the time to act is now. So watch this video till the end.
Today, we're going to be going through the EFP very briefly, as this will become more on your radar. I'd like to help you get a handle on it so you can interpret it as you see fit. Very simple run through. We're going to go through silver in September. Silver has a very specific history, September behavior, and we're going to show that to you so that you know what to expect, and then know what to expect in the 2 months after that, and then know what to expect in the 6 months after that. And September 11th is an important day, I think, for many people. All right, EFP comment. You're going to start hearing people talk about the EFP. The lower silver goes, the more it becomes on the radar for people who either A, understand the relationship between the physical market and the futures, or B, don't understand it, but want to talk about it. I want you to be able to understand what it is people are talking about, if you don't already. But let's start with this. The exchange for physical, or EFP, all it simply is, it represents the differential between the spot market. We'll say that's the London market. That's where the biggest spot market is. And the COMEX futures can be any number of days you want, but we're going to use the 30-day future right now. So the exchange for physical represents the differential between the two pink dots. Normally, the two pink dots are as I'm showing you, not necessarily these exact numbers, but they are as I show you, meaning spot trades under the 30-day future. So spot is here, 30-day future is there. The 10 cents, the differential, right? You can also call that a contango if you're a futures guy. That differential represents the cost of silver if you were to buy it 30 days from now. Two of the changes that I can make very clear, very simply for you are, as interest rates go up, the differential widens. Nothing else happens, right? As the spot price drops, or as the whole market drops, I should say, the differential shrinks. And as the market rallies, differential widens. And that's a product of the asset is worth more money, so it costs more money to borrow against it. Those are the normal operating behaviors. What's not normal is every so often you will see the differential shrink, not because interest rates are coming in. That would be normal. You'll see the differential shrink, not because the whole market is dropping, because it's kind of all flattens out as you go to zero. But you'll see the differential shrink because of market behavior, because of participant behavior, because people are diverging in the reasons that they're doing things. Over here, if I'm bidding, I might not be bidding, I might be bidding. That's where the whole spoofing comes in. But speculators selling drive the price down, and the relationship will contract. Now, what keeps the relationship from contracting normally? Well, there's arbitrage here. If I'm JP Morgan, or I'm Goldman Sachs, or I'm Citibank, or I'm Bank of America, if this is 22 and that is 22.10, let's say that's normal. What makes it normal? Interest rates, cost of carry, what have you. But if I'm Bank of America, let's say, and somebody is willing to sell me futures for $22 all the way down here, while I have a buyer of spot metal in London at $22, well, I'm going to sell it to my own customer at $22 and buy it from the COMEX guy puking at $22. Why? Because I'm buying silver a month from now with no interest rate cost. And I'm selling silver now. So the same price trades now and 30 days from now, but I don't need to put that money up for 30 days. I can take that 30-day money and put it in a CD and earn 5% for 30 days. That's the arbitrage. And that arbitrage is extremely important between London and the US. And that's where a lot of the money is made on an operational business. Not a good month for September. Don't go slitting your wrists. Not that you would anyway. September historically is a bad month for silver. I'm telling you that. Prepare yourself for it. You don't care because it's normal operation. It's what happens after September that the bulls care about. So let's go through September. I wrote a whole article on why it's bad for silver, but let me just show it to you right now. All right. So here's silver going back, I don't know, to 2014. So I'll call it 9 years. All right. In September 2014, silver is here. It drops. September 2014, silver is here. Small drop, but you'll notice that the market had already dropped heading into that. Silver here, it's actually a green month, but it's after a down month. In other words, all of these months, all these September so far are in the process of dropping or pausing a drop. Right now we have September here, it's just outright red. September here, it's green, but it's after a big sell-off. September here, it's after a big rally, but it's red. Right? September here, well, I have to tell you that's pretty obvious right there. September here, again, red. September here, green, very green. We'll get into that in a second. But after a long, painful sell-off that we all experienced. By the way, you see this green one here? That's India buying last year. And here we are in September this year. So you look at that and you say, well, just looking at September and not looking at anything else, odds are it's going to be a red month. In the meantime, just know that the BRICS and the rest of the world outside of this little United States bubble that we live in is buying silver and gold. And the price is only kept in this area so they can accumulate more. And when they're done accumulating, when there's no more above ground silver to be had, then the price will float higher. That's it. We'll do the 9/11 thing some other time. Now's not the time to do it. But it's 22 years later. I just want to mention one person's name. I'm Vince. This has been the Silver Fix. September to remember, not to forget, because after September comes Christmas or Hanukkah or Kwanzaa or Festivus, whatever you celebrate. The presents come after September.
As we conclude this eye-opening discussion with Vince Lancy, remember that knowledge is power. Don't just follow the crowd. Trade with insight and foresight. Stay informed, stay vigilant, and consider the global perspective. Tomorrow is uncertain, but your actions today can shape your financial future. Thank you for joining us. And until next time, keep your eyes on the markets and your finger on the pulse of change. And please like, share, and subscribe if you like it.